Could China's next move in the trade war shake the global economy? The U.S. China trade war has evolved into a high-stakes geopolitical conflict with economic repercussions that extend far beyond tariffs and trade deficits. As tensions escalate, the possibility of China leveraging its $760 billion stake in U.S. Treasury bonds to destabilize global markets looms large. This scenario could really redefine the rules of international finance, shaking the foundations of global economic stability and challenging American economic dominance. China's vast holdings of U.S. government debt represent one of the most significant points of economic interdependence between the world's two largest economies. For decades, this relationship has been mutually beneficial. China purchases U.S. treasuries to keep its currency, the yuan, artificially low and maintain export competitiveness, while the United States benefits from lower borrowing costs due to strong demand for its debt. However, this delicate balance is now under threat as geopolitical tensions intensify. The nuclear option. China's ability to sell off a substantial portion of its U.S. Treasury holdings is often referred to as the nuclear option in economic circles. If Beijing were to flood the market with U.S. bonds, it could cause interest rates to spike significantly. Analysts estimate that such a move could add 30 to 60 basis points to long-term yields, making borrowing more expensive for American consumers and businesses alike. Mortgages, corporate loans, and even government debt would become costlier, potentially destabilizing the $27 trillion treasury market, the backbone of global finance. Recent signals. There are already subtle indications that China may be testing this strategy. Overnight surges in treasury yields, rising from 4.1% to 4.5%, have coincided with Beijing's trading hours, suggesting covert divestment activity. While these moves remain small-scale for now, they serve as a warning shot to Washington about the potential consequences of escalating trade tensions. Chaos in the bond market. Could this be a Fed rescue mission? If China were to initiate a large-scale sell-off of U.S. treasuries, the Federal Reserve would likely face one of its most significant challenges since, well, the 2008 financial crisis. The ripple effects on financial markets could be honestly catastrophic. To stabilize the treasury market and prevent a liquidity crash, the Federal Reserve might have no choice but to intervene aggressively by purchasing bonds en masse, a strategy known as quantitative easing or QE. While QE could help restore market stability in the short term, it carries some pretty serious risks. Massive bond buying would likely reignite inflationary pressures, and it could really undermine confidence in the dollar's value as a global reserve currency. Higher U.S. interest rates triggered by a treasury sell-off would have profound implications for emerging markets. Many developing nations rely heavily on dollar-denominated debt, and a stronger dollar would make it more expensive for them to service their obligations. That could, unfortunately, lead to widespread defaults and financial instability across multiple regions. China's long game, diversifying away from the dollar. China is not merely threatening action, it's already taking steps to reduce its reliance on U.S.-denominated assets and strengthen its financial independence. In recent years, China's central bank has been steadily increasing its gold reserves as part of a broader strategy to diversify away from dollar-based assets. Gold now makes up an expanding share of China's multi-trillion-dollar foreign exchange reserves, providing a hedge against potential volatility in currency markets. UN ambitions. So, Beijing has really stepped up its efforts to promote the yuan as an alternative global currency. The People's Bank of China has rolled out some key measures to encourage the use of the yuan in international trade settlements, while also cutting back on dollar purchases by state-owned entities. On top of that, Chinese banks have been directed to aggressively sell dollars in the foreign exchange markets, all in an effort to bolster the yuan's value. Euro and yen shifts. Now, while Europe and Japan don't quite have the capacity to absorb all of China's massive reserves, Beijing has been steadily moving toward diversifying into euro and yen-denominated assets. This shift is really part of China's broader strategy to reduce its dependence on any one currency, or more specifically, on financial systems that are dominated by Western powers. The new financial era, de-dollarization, accelerates. What we're seeing here is that China's actions are just one piece of a much larger global trend toward de-dollarization. That is, a growing movement to lower the world's reliance on the U.S. dollar as the primary reserve currency. Trade wars meet currency wars. By cutting down its exposure to dollar-denominated assets, China is looking to protect itself from potential U.S.-imposed sanctions and also to manage the risks that come with fluctuations in American monetary policy. This strategy aligns with Beijing's broader goal of challenging U.S. economic dominance and creating a more multipolar financial system. The dollar's share of global reserves has already fallen below 60%, reflecting growing interest in alternatives such as the yuan, euro, and gold among central banks worldwide. While no single currency is poised to replace the dollar entirely, this fragmentation signals a shift toward a more decentralized global financial order. The bottom line is, despite its potential impact, a full-scale treasury dump by China remains pretty unlikely for several reasons. First and foremost, such an action would actually hurt China's own economy by driving up the value of the yuan, which, would really undermine its export-driven growth model. Additionally, destabilizing global markets could alienate key trading partners and, harm Beijing's long-term strategic interests. That said, even modest sales or, covert divestments could still send a powerful message to Washington about the consequences of escalating tensions, without outright triggering mutual economic destruction. These kinds of actions would force U.S. policymakers to confront some uncomfortable truths about vulnerabilities in America's debt-driven growth model, a system that honestly relies pretty heavily on foreign investment in treasuries. As this next chapter in the trade war unfolds, all eyes are going to be on the bond market, a critical battleground where economic power dynamics are being reshaped in real time. Whether it's through overt actions or more subtle shifts in strategy, China's maneuvers could signal a seismic transformation in global finance, one where American dominance just isn't guaranteed anymore, and new rules start to define international economic relations. In conclusion, while China's next move in this trade war is still uncertain, its ability to leverage financial tools like treasury holdings really highlights just how deeply economics and geopolitics are intertwined in today's world. The implications for global markets? They're huge, from rising interest rates and inflationary pressures in the United States to cascading effects across emerging economies that are already burdened by dollar-denominated debt. As more nations look for alternatives to dollar hegemony, whether it's through gold reserves or regional currencies, the era of unquestioned American financial supremacy might honestly be nearing its end. The stakes in the U.S. China trade war? They've never been higher, and the potential for China to weaponize its $760 billion in U.S. Treasury holdings could really mark a turning point in global finance. As more countries challenge the dollar's dominance and actively seek out alternatives, the world might be standing on the edge of a new financial era, one that's defined by uncertainty, shifting power dynamics, and major economic realignments. At this point, the question isn't if the global economy will change, it's how quickly and how drastically. What do you think? Could China's next move actually reshape the global financial system? Let us know your thoughts in the comments below. And hey, don't forget to like this video, subscribe to our channel for more insights on global economics, and hit that notification bell so you never miss an update. Oh, and share this video with others who are curious about the future of international finance.